Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Historical Market Trends and Their Implications. Historical market trends offer invaluable insights into the ebb and flow of economic activity, providing a robust foundation for strategic investment decisions. By examining these trends, investors can identify patterns and anomalies that inform future market behavior, thereby enhancing their ability to make informed investment choices. This lesson explores the significance of historical market trends, the methodologies for analyzing these trends, and their implications for strategic investments, drawing on a rich tapestry of historical data and case studies. Market trends are the general direction in which a market is moving over a particular period. These trends can be categorized into secular, primary, and secondary trends. Understanding these categories is crucial for investors as they reflect the underlying forces driving market movements. For instance, secular trends span years or even decades and are often driven by fundamental changes in economic conditions, such as technological advancements or demographic shifts. Primary trends, lasting several months to years, typically correspond to business cycles, while secondary trends are short-term fluctuations influenced by market sentiment and external events. One of the most illustrative examples of a secular trend is the post-World War II economic boom. This period, often referred to as the Golden Age of capitalism, saw unprecedented economic growth and stability in many Western countries. The Dow Jones Industrial Average experienced significant growth, rising from around 200 points in 1946 to nearly 1,000 points by the mid-1960s. This long-term upward trend was driven by factors such as industrial expansion, technological innovation, and increased consumer spending. Investors who recognized these underlying drivers and invested accordingly were able to capitalize on substantial returns over the period. In contrast, the dot-com bubble of the late 1990s serves as a cautionary tale of a primary trend driven by speculative fervor rather than fundamental economic strength. During this period, the Nasdaq Composite Index skyrocketed from around 1,000 points in 1995 to over 5,000 points by March 2000. However, this rapid ascent was not sustainable, as it was largely fueled by excessive speculation in internet-related stocks. When the bubble burst, the Nasdaq plummeted to around 1,100 points by October 2002, leading to massive losses for investors caught up in the frenzy. This case underscores the importance of distinguishing between genuine growth and speculative excess when analyzing market trends. The Great Recession of 2007-2009 provides another critical example of how historical market trends reflect broader economic conditions. The housing market collapse and subsequent financial crisis led to a sharp decline in stock markets worldwide. The S&P 500 index dropped from a peak of around 1,565 points in October 2007 to a low of about 676 points in March 2009. This primary downward trend was driven by systemic issues within the financial sector, including excessive risk-taking and the proliferation of complex financial instruments, such as mortgage-backed securities. The subsequent recovery, marked by a slow but steady upward trend, was fueled by significant government intervention and monetary stimulus. Investors who closely monitored these trends and adjusted their strategies accordingly were better positioned to manage risk and capitalize on the recovery. Methodologies for analyzing historical market trends are diverse, ranging from technical analysis to fundamental analysis. Technical analysis involves examining historical price movements and trading volumes to identify patterns and predict future market behavior. This approach is predicated on the belief that market prices reflect all relevant information and that patterns tend to repeat over time. Common tools used in technical analysis include moving averages, relative strength index, and Bollinger Bands. For example, Moving averages smooth out price data to identify the direction of the trend, while RSI measures the speed and change of price movements to identify potential overbought or oversold conditions. Fundamental analysis, on the other hand, involves evaluating the intrinsic value of an asset based on economic indicators, financial statements, and industry conditions. This approach is grounded in the belief that market prices will eventually converge to their intrinsic value, making it essential to assess factors such as earnings, revenue, and growth potential. For instance, during the bull market of the 1980s and 1990s, fundamental analysis of technology companies like Microsoft and Intel revealed strong earnings growth and market potential, justifying their rising stock prices. Investors who conducted thorough fundamental analysis were able to identify undervalued stocks and achieve significant returns. The implications of historical market trends for strategic investments are profound. By analyzing past trends, investors can develop strategies that align with the prevailing market conditions and anticipate future movements. For instance, during periods of economic expansion and rising markets, growth-oriented investment strategies that focus on capital appreciation may be more effective. Conversely, during economic downturns and declining markets, defensive strategies that prioritize capital preservation and income generation, such as investing in bonds or dividend-paying stocks, may be more appropriate. Moreover, historical market trends provide valuable lessons on diversification and risk management. The concept of diversification, which involves spreading investments across a variety of assets to reduce risk, is supported by numerous historical examples. For instance, during the dot-com bubble, investors who diversified their portfolios to include a mix of technology and non-technology stocks, as well as other asset classes like bonds and real estate, were better able to withstand the market downturn. This underscores the importance of not putting all one's eggs in one basket and maintaining a well-balanced portfolio. Another critical lesson from historical market trends is the importance of maintaining a long-term perspective. Markets are inherently volatile, and short-term fluctuations are inevitable. However, historical data shows that, over the long term, markets tend to recover from downturns and continue to grow. For example, despite numerous crises and corrections, the DJIA has consistently trended upward over the past century, growing from around 66 points in 1900 to over 33,000 points in 2021. Investors who adopt a long-term perspective and remain committed to their investment strategies are more likely to achieve their financial goals and avoid the pitfalls of market timing. In conclusion, historical market trends provide a rich source of information for strategic investment decisions. By examining these trends, investors can gain insights into the underlying forces driving market movements, identify patterns and anomalies, and develop strategies that align with prevailing conditions. The lessons gleaned from past market behavior, such as the importance of diversification, risk management, and maintaining a long-term perspective, are invaluable for navigating the complexities of the financial markets. As the adage goes, history doesn't repeat itself, but it often rhymes. By learning from the past, investors can better prepare for the future and enhance their chances of achieving long-term success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.